Hello and welcome to this Markets Today special. I'm Udayan Mukherjee with Ms. Abha Bakaya and our guest on the show today, Andrew Holland of Avendus, who keeps a keen eye on not just India but global markets as well. Andrew, great to speak to you again. How is it looking? I mean, it's been a few good weeks on the trot. We are making new highs in India. The S&P is up nearly 15% from its recent lows. How much longer do you see this cheer lasting?
Yeah, no, it's been a great year for India overall, and I think, Udayan, it's probably been easier to kind of call the global markets than it has the Indian market. It's been so resilient. Perhaps that because we have more deeper sectors than some of the other emerging markets, and more variety of sectors. But valuations remain lofty, and earnings have yet to kind of really pick up. I mean, again, at the beginning of the year, we were talking of 20% plus earnings growth, and it's looking as though we're going to get just about double-digit earnings growth for this year. So unless earnings really start to kind of pick up momentum going into next year, it's going to be hard for the PE expansion just to keep continuing at this pace. So what you might get is what we've been seeing over the past year is rotation into different sectors. So for example, I mean, today it's a very short-term move, but if oil remains or could head lower because of what's happening in China, then obviously sectors like paints and tyres and the kind of oil marketing companies come back into play after being out of favour for so long. So those are the kind of rotation in the market which could keep things buoyant a little bit longer.
The fear though, Andrew, is that while we may end the year well, as we start the new year again, some of the recession worries and the earnings slowdown worries come back, and 2023 starts not on a very cheerful note. It's happened in the past where you end a year well and the next year does not follow up in quite the same spirit. Is there a risk of that this time around too?
There's always that risk. I remember, again, I was probably speaking back in 2007 when India was decoupling from global markets, only to find out what happened in 2008. So there's still that risk that unintended consequences of interest rate hikes globally, could lead to, some problems in the financial markets. We've seen it in the cryptos. We saw it with, in terms of the UK pension funds. So, there's something out there which, we still have to watch out for. And it will be financial. It won't just be economic. I think the consensus view going into 2023 is that the Fed goes on hold, emerging markets, because some of them are a little bit more aggressive in terms of their interest rate hikes at the beginning, will be able to reduce interest rates a little bit quicker than we would see globally. Therefore, money would come back to emerging markets. It's something we've been talking about, but India, would probably be an underweight sector, underweight country in that kind of scenario, because obviously you're looking at global growth picking up sometime towards the back end of 23, 24. And therefore you'd be looking at those exporting countries such as Korea, Taiwan, China, as another kind of country where valuations are more compelling than it is India. I think the concern for India going forward is probably that if that doesn't happen, the recession is a lot deeper than the market's kind of currently baking in, then that could have an impact on our exports, which in turn would have an impact on the current account deficit, balance of payments, and that would put more pressure on the rupee. So those are the risks that are out there going into 2023. And you're right in that, at the moment, we're looking at that, still at that Goldilocks scenario of everything playing out very well for emerging markets. But usually when consensus is there, something else happens.
And given that view on 2023, what's your portfolio positioning like now, Andrew, between the domestic sectors and the global facing sectors? How are you mixing it up going into next year?
So we're keeping more domestic at the moment because that's where I think the growth continues to be in certain sectors. We think next year is going to be a little bit more challenging for the markets to move higher. They might go higher in terms of just the relief rallies for emerging markets, so money comes through, and some of it will end up in India. But I think it's going to be the themes that play out today, which is where you need to position yourself rather than just think about the index next year. Because as I said before, valuations are challenging for that PE expansion just to continue without seeing the kind of relevant earnings growth for the whole of the index. And we've actually been seeing more downgrades after the last quarter earnings announcements, than we've seen in the most of the year. So I think going into this quarter, at the end of this quarter, that we'll probably see more downgrades going into 2023. And I think that's the risk for the market. It might be just that we'll hold sideways and take some time before we move ahead. But I think the risks at the moment are probably more to the kind of downside because of the overvaluation and the momentums really kind of push the markets to levels where it's difficult to find value. And I think one of the things that we're seeing and hearing is that a lot of investors, particularly the family offices, high net worth individuals, have a new asset class now, which is the debt market, which is giving you, kind of secure returns of that 7.5%, 8%. Yes, you're locked in for a time, but obviously you're not taking risk at markets being where they are today.
So in light of that scenario, Andrew, what would continue to be your top picks, or would you be kind of holding back for the moment, seeing how things stabilize?
No, we have been putting more money to work. We still believe that inflation is probably peaked in the short term. The question is whether it will linger for longer, and that kind of stagflation kind of scenario starts to come through. But we're very much in the camp that inflation will start to tick down now globally, and therefore that deflation play, which is obviously banks and consumer, mainly autos, would still play out very well over the medium term. So that's where we're putting our money at the moment. But the themes that we're looking at, going into 2023 would be more towards, the capex cycle picking up globally and in India, particularly in those sectors where, supplies or security of supply has been an issue, not just globally, but for India too. So, areas like semiconductors, we think electronics will be another big area for investment by Indian companies over the next year. So I think it's going to be those pockets of themes which play out, which will be, more beneficial in terms of, getting better returns than just looking at the index.
What's the call on IT, Andrew? Because that's the one which seems to be dividing the street almost equally, straight down the middle. Some believe it's a great time to be getting into them. Some believe no, this is not the sector which is going to perform and deliver returns. What are you doing in that space?
I think we still remain, probably more negative in the shorter term because, we are heading into recession, globally, and in the US, maybe it's a milder recession from what we can see at the moment in the US. But until I think the Fed stops, increasing rates, then the tech sector in the US is going to be under pressure. And if you take things like, what's happening in China today, I mean, obviously that's going to have an impact on Apple, Tesla, and these are big heavyweights in the tech sector. So, it has that, that sentiment impact that, it's going to be a slowdown first, which will affect our companies here in India. But of course, once you get past that interest rate hike and we're on pause, then obviously, the growth stocks or the tech stocks in the US will be looked at again more closely. They have been beaten down very significantly over the past year and a half. So you might get, kind of bouts of that sector starting to pick up, which again will become a tailwind for our IT companies. But I don't think that's the first half story of 2023. So I'd still be more negative in the very short term, really driven by the sentiment of a recession and the problems which are happening in China.
The sector where there seems to be growing bullishness, though, is public sector banks, Andrew. For the first time, maybe in more than a decade. Have you included any of those names in your portfolio?
So, Dane, I think we spoke over many years about the PSU banks, and it's always been our view and continues to our view. I'd rather rent them than own them. There's always going to be times when the banking sector, particularly the private banks, lead the way. And then, the value remains at, some of these, public sector banks where, the valuations were, very, very cheap. The high beta, it's a trade. I'm not sure I want to be in those banks on a long-term basis until one, either the management is given a longer tenure, which I believe that the government's going to do now, but two, maybe the government divests and there's more private kind of thinking in terms of how those banks go forward, because apart from State Bank of India, really none of them have the size to compete now with and the technology to compete with the private banks. So it's always that nice trade that you can have, and it's been a very good trade, don't get me wrong, but it's not one that I think I want to own going forward, because of the problems we've seen in the past. But at the moment, we're at the very start of a capex cycle, a pickup in economic growth in India, and therefore, some of the problems which have haunted these public sector banks are probably not going to be there for some time. So the kind of the momentum will continue in the very short term. But as I said, it's rent only, not own.
Andrew, what are you thinking about some of these tech plays and the kind of battering we're seeing on most of them, and where we're not seeing a battering, we're seeing some very interesting questions being raised. Is it a clear avoid for you, or do you still see a case for investing in a Paytm or a Nykaa at these levels?
It's an interesting time to be looking at them, and we are going to start doing that in more detail, because you've got the combination of the prices have fallen very sharply from the IPO prices to obviously with the shareholdings being open to now being sold. You're getting a lot of movement in the holders of each of the companies, as some take some money off the table. And therefore, if you believe in the long-term value of these companies going forward, then it's probably the right time to be looking closely. I'm not saying we're going to dip our toes yet, but it's a time where we think that the valuations, actually it's not really the valuations, but it's more to do with the cash flow, and we're starting to see that starting to appear a lot better for some of these companies going forward. So it's the right time to be looking. I'm not saying it's the right time to invest just yet.
There's a lot of excitement around manufacturing as a theme, Andrew, in the market. Within that, I mean, one of the sectors where people generally scouted for mid-cap opportunities would be the auto ancillaries or auto component space, because there are quite a number of decently managed companies in that space. Do you have any strong views on either ancillaries or the automobile space per se as we go into 2023?
No, we like the autos. We think, the consumption story in India is not going away. It's a long-term theme anyway. I would probably go for the passenger cars rather than two-wheelers at the moment, although we are seeing a pickup in demand for two-wheelers and tractors as well. But I think that might be just a more seasonal part to the buying patterns that we normally kind of occur in India. So the way I want to play it is really whilst electric vehicles I think will be very, very important, I think it's the auto parts makers I think will benefit, because it's hard to pick out who would be the real winner in electric vehicles at the moment, because everyone's investing and there's a lot of change ahead. But the auto parts companies will be the ones that be the beneficiaries of this. So I think it's a combination of the four-wheelers and the auto parts companies which I would be looking at to play, not just from a consumption, but also from the fact that we think inflation is starting to kind of come to an end, not just globally but for India as well, and therefore we will see interest rates coming down sometime next year in India, which gives people more disposable income. So I think the auto sector plays into that very nicely, and auto parts as a play on that growth, but also play on the growth in electric vehicles going forward.
Well, Andrew, good hearing your thoughts as always. Thank you very much for taking time out today.
Thank you.
If you like the video, do like, comment, share and subscribe.